What's up everybody, my name is Yasin and welcome back to my channel. In this video, we are going to cover the major story that came out last week. Bank of Canada announced they're going to end QE program, aka money printing program. Also, they said they're going to increase the interest rate from as early as April next year. What is the impact on Canadian economy and how this is going to impact specifically the real estate market? So stay tuned till the end. Let's dive in. The Governor of Bank of Canada, Tiff Macklem, came out last Wednesday and they announced that they are going to end the QE program, also known as quantitative easing, also known as money printing program, which means they were buying the government bonds since March 2020 and now they're going to end that. So what it means the Canadian government has been selling these bonds to only the one buyer in Canada, which is Bank of Canada, and up until now the Bank of Canada has been in exchange financing the fiscal spending around $354 billion. So that's one thing. They are going to end that program, and they also announced that they're going to increase the interest rate from as early as April 2022. Now, a lot of people were shocked, but I was not shocked, to be honest. And I can explain you why. A lot of people were shocked because the same guy, Tiff Macklem, has been repeatedly saying and telling Canadians that rest assured the rates will going to stay at that level for quite some time. So if you want to buy a real estate or any other asset, you should be confident that the rates will going to stay as low as today for quite some time. That was Tiff Macklem's words. Now, a lot of Canadians were shocked because he's the same guy telling Canadians to go and buy properties because the rates are going to stay low. Now he's putting that date earlier. Initially, they said they're going to raise interest rate by 2023. Now they're saying April 2022. And this is just my analysis. I could be wrong, right? But this is my research and analysis. And according to my research, the Bank of Canada is under immense pressure, right? Because the inflation is running hot, 4.5% right now. And they also said they're predicting the inflation is going to run even hotter by the end of this year. It's going to touch 5%. So this is Bank of Canada's mandate to control inflation, to bring it down to 2%. That's their mandate. So they are under pressure to deliver that mandate. They're going to take some actions to deliver that mandate. Now, the first thing that they have to do is to taper that asset buying program, which is quantitative easing. Now they said they're going to stop it and then slowly start raising the interest rate. Now, just understand what I said here. They're going to stop QE program, which means there will be no more buyers in the market to purchase government bonds. Bank of Canada is the largest holder of Government of Canada's treasury bonds, around 40% or more than 40%. Which means if there is no other buyer to purchase Canadian bonds, who is going to fund that fiscal spending going forward? That's a big question mark. And you know how much is the fiscal deficit? Around $350 billion. I see two things going to happen. Number one, if there's no more buyer to purchase government bonds, then they will have to start raising taxes, cut spending in other areas, welfare, education, other business investments, and then start covering those fiscal deficits where they have no other income coming from other source, right? So that's one scenario. The other scenario is, when the Bank of Canada starts raising interest rate, the economy will certainly react negatively because there is nothing in the economy that can show us, it's going to jump ahead and goes back to pre-pandemic level. So certainly the real estate market will be impacted. I will not say it's going to crash because rising interest rate by 25 basis points on a quarterly basis it's not going to crash the market, but it will certainly slow down the market and push the buyers away, because when they see the interest rates are going up, that means the mortgage is going to get expensive. Okay, so the people who are not able to afford monthly interest payment or monthly mortgage payments at a given interest rate, then of course their buying power will be reduced, right? So there will be no more crazy buyers available to bid and buy properties by paying $200,000 more above asking. So that's going to happen. And as soon as the real estate market, stumbles a little bit, then the rest of the economy will also feel that pressure. Okay, so the economy will react negatively, and then what will happen? They will see the impact, and they will start, reducing the rates again. Perhaps the Bank of Canada will jump in and start the QE program again. Who knows? But my point is, if you look at the total government fiscal deficit, $354 billion. Who's going to pay for that deficit if Bank of Canada is not going to buy their treasury bonds? For someone will have to cover that deficit. If there is no other buyer, that means the government will go into austerity measures, which means less spending in welfare, education, healthcare, other business investments, and they will start, reducing the investment and then spending and then cover their deficit. Okay, which is of course not a good sign, and this will also impact the overall GDP growth and economy as well. And the interest rate will also going to impact, because if you look at the household debt to GDP ratio, it's 117%. What does it mean? It means 117% of the income is being spent to service debt. If the interest rate goes up, what will happen to the servicing debt issue? Not only the household will feel the pressure, but also the government, the corporation, the municipalities who have taken a lot of debt, who have leveraged themselves, will feel an immense pressure, because a lot of their income or revenue is going to be spent in servicing the debt. So I see this is going to be a very complex problem to solve. To be honest, Bank of Canada do not have any other option, and the government of Canada have no other option but to increase taxes, cut spending, austerity measures. And if that doesn't work either, then Bank of Canada will jump in again, lower the interest rate again, and then also restart the QE program, because the overall financial system is on life support. They have been kicking this can down the road since 2008 crisis. Same is happening in US. So I don't think this will be a long-term policy. We will have to see. This is just my assessment based upon my research. I could be wrong, but that's what I'm seeing. So they will certainly raise the rates, but then as a result of that, the economy will respond, and then they will have to take a step back again and see, okay, how they will recover that. Okay, maybe they will lower the rate again, keep the rate at a lower, maybe 0.25 or 0.5%, and then perhaps start the bond buying program again. Who knows? So that's all I wanted to share with you. Give me your comments and ask me questions. What do you think is going to happen? And what is your theoretical analysis in terms of how this monetary policy is going to impact going forward? I would be very interested to hear and understand your perspective. So please put your comments down below. And then if you like it, give me a thumbs up and hit subscribe. And then I will see you in my next week video. Take care.